In this video, we will compute the capital gain of Mr. Y. Let us see what is given in this problem. Y furnishes the following particulars and requests your advice as to the liability to capital gain for the assessment year 17-18. Jewellery purchased by him on 10th March 1995. Before we proceed, let us try to understand whether jewellery is a capital asset or not. So if you see, it is clearly mentioned capital asset refers to any property excluding the following specified asset. So in this, if you see point number 2, it is given any personal effect that is movable property for personal use is not a capital asset. Why? Because it is excluded. However, jewelry is considered to be a capital asset. So jewelry is a capital asset. So it is clear, even though jewelry is personal and movable, still it will be considered as a capital asset. So we have understood that jewelry is a capital asset, and on sale of jewelry, if we generate profit, we are liable to pay capital gain tax. Now let's see what they are saying. Jewelry is purchased by him on 10th March 1995. So he bought this jewelry after 1481. So you should remember there are different cases or different situations of indexation. For each and every situation, the formula for index cost of acquisition differs. Now in this case, he is buying this jewelry after 1481. So let's see the formula for index cost of acquisition if any asset is acquired after 1481. So if any asset is acquired after 1481, the formula for index cost of acquisition will be actual cost of acquisition into index of year of transfer upon index of year of acquisition. And the formula for index cost of improvement will be actual cost of improvement into index of year of transfer upon index of year of improvement. So we will have to apply the formula of case number 1, asset acquired by SSC after 1481. So now he has bought this jewelry on 10th March 1995 for rupees 1,05,000. So what is this 1,05,000? This 1,05,000 will become the cost of acquisition. Right? This is the purchase price of jewelry 1,05,000, which was sold by him for a consideration of rupees 4,85,000. Now what is this 4,85,000? This 4,85,000 is sales consideration. Now what is important for us is when this jewelry is sold. This jewelry is sold on 2nd November 2016. That means in which financial year? It is 2016-17. Right? So now let us find out whether this asset, means jewelry, is long-term capital asset or short-term capital asset. So for that, let me take you to the concept of short-term capital asset and long-term capital asset. Now jewelry is not a shares or debenture. It is other than shares or debenture property or asset. So the cutoff for other than shares or debenture is 36 months. Right? So if any asset other than shares or debenture is sold within 36 months from the date of purchase, it will be treated as a short-term capital asset. If it is sold beyond 36 months, it will be treated as long-term capital asset. Now, in our situation, jewelry is purchased in the year 1995 and sold in the year 2016. So it is, the difference of this is more than 36 months. The holding period of this jewelry is more than 36 months. Hence, jewelry will be treated as long-term capital asset. So that means if Mr. Y is selling, Mr. Y will have to pay long-term capital gain tax. So for that, you should know how to calculate long-term capital gain. So this is how you are supposed to calculate long-term capital gain. You will have to take full value of consideration, which is nothing but the selling price, less expenses on transfer like brokerage, etc., less index cost of acquisition, less index cost of improvement. So finally, you will get long-term capital gain, right? Okay. So we have understood that jewelry is a capital asset and it is a long-term capital asset. We have understood the format of calculating long-term capital gain, right? Now, what is the next information given to us? He incurred following expenses. At the time of purchase, 2000. At the time of sale, 4000. Now, where we will have to consider these two expenses. See, at the time of sale is nothing but expenses on transfer, brokerage which you are paying, 4000. So this will go into that format. This will be treated as expenses on transfer and will be subtracted from full value of consideration, right? What about this 2000 which you have incurred at the time of purchase? Now this 2000 will be added to the purchase price. Your cost of jewelry or the purchase price of jewelry will go up because the actual purchase price is 1,05,000 and you have incurred 2000 at the time of purchase. So your total cost of jewelry will be 1,07,000. That is 1,05,000 plus 2,000, right? So in case of cost of acquisition, we will take 1,07,000 instead of 1,05,000. On the facts given above, compute the capital gain chargeable to tax. Now CII, this is cost inflation index. It is already given. For 1994-95, it is 259 and for 2016-17, it is 1125. Right? So let us start the solution. Before you actually calculate the capital gain, you will have to give this information. You will have to record this information or write this information, like the name of SSC, Mr. Y, assessment year 2017-18, previous year 2016-17, status individual, residential status resident and ordinary resident, PAN number. If you know or if the information is given in the question, you can record it here or you can leave it blank. Then you can start computing the income from capital gain. You will have to prepare two columns, particular column and amount column. Starting, you will have to start with the heading jewelry bracket long-term capital asset. Now, as we know, the format first will be full value of consideration. So what is full value of consideration? It is nothing but the selling price. So if you see the selling price, it was sold by him for a consideration of 4,85,000. So selling price will be 4,85,000, which is nothing but full value of consideration. Less expenses on transfer, it is brokerage 4,000. If you see, it is given in the question at the time of sale, brokerage incurred is 4,000. So this 4,000 will be subtracted from the full value of consideration. Then less index cost of acquisition. As you know, the first case formula of index cost of acquisition will be applicable. So it will be actual cost of acquisition into index of year of transfer upon index of year of acquisition. Now, if you talk about actual cost of acquisition, so it won't be 1,05,000, it will be 1,05,000 plus 2,000, 1,07,000. So your actual cost of acquisition is 1,07,000 into index of year of transfer. When actually you're transferring, in which year you're transferring this jewelry? You're transferring in the year 2016-17. So 2016-17, your CII cost inflation index is 1125. So into index of year of transfer is 1125 upon index of year of acquisition. Index of year of acquisition, you have acquired this asset in the year 1995. Sorry, 94-95. So 94-95 CII is 259. So upon you will have to write 259. So 1,07,000 into 1125 upon 259 will give you 4,64,768. So once you subtract expenses on transfer and index cost of acquisition from full value of consideration, you will get long-term capital gain, which is 16,232. So this is how we calculate long-term capital gain. Thank you for watching this video.